Hello and welcome to the Proptech Hot Seat on iPropertyRadio with myself, Carol Tallon, the show where we explore trends and technologies driving innovation across the built environment. This show is brought to you in partnership with Proptech Ireland, the hub for innovators, investors, and indeed for industry leaders. Today, I'm delighted to be joined by Nuno Brito y Cunha, Lead ESG Advisor with Measurabl. Nuno, you're very welcome. Thank you for joining us today.
Thank you for having me.
I've spoken to a number of your colleagues at Measurable in the past. I know it's a platform that we featured previously on the show. You're certainly one of the early leaders in the ESG space. But you might just remind, for anybody not familiar, not familiar with Measurable, you might just kind of take us through the company and what the primary offering is.
Sure, thanks, Carol. So Measurabl, as you mentioned, was one of the first, I would say, software platforms aimed at collecting, managing, and reporting sustainability data in the real estate space. So very focused on working with commercial real estate owners and investors, and so that was started around 10 years ago, and it's evolved to working now also with capital markets, financial providers, and really focusing on that data element and trying to bring some intelligence to the market around sustainability.
Very good. And what's your own background? Do you come from a real estate background yourself?
Yeah, so I've been doing real estate now for about 4 years, but prior to that, I was very focused on sustainable finance, and as we embrace this new term, a relatively new term of ESG, it's it's a nice intersection between sustainable finance and real estate.
Well, I would probably describe it as something better than a nice intersection. I mean, we've been exploring the drivers of ESG adoption over the last number of years. And what we've seen very clearly is that finance was leading ahead of regulatory drivers in most jurisdictions. So I would say that actually coming from the sustainable finance side of it, would you recognize that maybe the capital markets were in this sense a little bit ahead of regulation? Would that be fair to say?
Yeah, I think it depends a little bit where you look. I think, if we take a look at the pension providers and pension asset funds in Europe, they've definitely been leading that charge for some time, and asking the questions of their investees on, what are they doing around these big issues that we have to deal with now around climate change, around collecting that information, being transparent, and disclosing it. For sure it's been a driver ahead of the regulatory curve, but that regulation now is front and center and is driving a lot more scale and adoption of sustainability reporting.
And actually, when we look at regulation ramping up to become the key driver, then actually what we're seeing is maybe what was establishing and what was emerging really as best practice over the past decade. We saw and we really cautioned of this widening gap between those who were doing it very well and those who weren't. Just wasn't even on the radar, or it was on the radar, but they didn't prioritize it. They weren't resourcing it, and they didn't really know how to go about it. Despite the huge rise and proliferation of new tools and technologies to do this. But now that regulatory factors are drivers across most jurisdictions, is that narrowing the gap? When you look at your adoption curve, where are we at the moment in that? Because I think I'm in a little bit of a bubble insofar as I spend my time talking to innovative people who understand technology, who understand the importance of ESG, and they get it. Whereas we know that's not true across it, and it's not representative of the entire real estate ecosystem.
No, absolutely, Carol. I think, we were actually discussing this internally, looking at that adoption curve and where we sit on it. And we've been very, privileged to, like you mentioned, you've spoken to a lot of my colleagues in the past, and we've been around for 10 years now. And when we were doing it, we were very much a pioneer in the space. And And where we feel like we're at now, we've crossed that barrier between early adoption, and we're moving into the adoption of scale in the market. And so we're seeing this sort of bifurcation between the early adopters that are, far along that curve. They've been reporting on ESG and sustainability for around, for almost a decade. They're well versed in the data they need, that is important, that they need to collect. They've resourced it. They've got teams now that are focused on it. But then on the other hand, we've got, the sort of the ones that are a little bit later to the party, that are coming into the fray now because of regulatory needs. And to them, they're at the start of their journey. And so they are now trying to understand how to go about it. They're trying to figure out how much they need to resource. And so the conversations we're having with them is around, so they know they've got I always look at it, there's a carrot and there's a stick. And I think, you've got the regulatory hand is a little bit of the stick. And it's not always the best way to drive adoption of sustainability reporting and the importance of that. But I think more interestingly, if we take a look at the market of real estate, commercial real estate in the last, let's say, year and a half, so from the second half of 2022, when the interest rates started coming up, and 2023 was a real sort of, the market was in shock at this new environment that it was in. And so we felt there was a lot of players were just sort of pressing pause, looking at the market, trying to figure out how to integrate sustainability, but with a lens of, return on investment. What's the business case behind it? Is there a business case? Is there a return on, starting to collect this data and reporting it? And can we see benefits to our business in doing so? And so the conversations we've been having the last 18 months have been very much around the return on investment, around implementing sustainability, data collection, management, and reporting on that. And, very much tagging on to the decarbonization journey that, that is there for everybody to try and achieve. So we're seeing that conversation. I think that conversation has matured. It's much more focused around ROI now than just sort of doing the right thing.
Yeah. And you touched on something there that I definitely want to return to, and that is maybe a shock across real estate right now. But I think in different jurisdictions, the shock is presenting in a slightly different way. So I would love to get your take, maybe with your international perspective, on what's happening in the commercial markets, and really how your clients are perceiving what's happening across the commercial market, the commercial property markets right now. But first, maybe just we'll take a step back and say, who are your clients? What is the makeup of the Measurable client?
Yeah. So we divide our sort of customer base into two factions. The first one is our sort of, I would say, more of our traditional customer, which is the real estate owner and operator. So we're talking big real estate owners, we're talking real estate investment trusts, investors in commercial real estate. That's sort of one pillar of it, where we help them effectively collect data on the buildings that they own and operate, and help them develop insights into those buildings, and then report to the market, to shareholders, to stakeholders in that space. And now we have a new emerging customer as well, which is more on the capital market side, where we're working with index providers for publicly listed indexes on stock exchanges. And we can't mention some of them at the moment, but we soon will be. And then on the other hand, we're also working with lenders. So the benefit of having been around for 10 years is that we've collected a lot of data on buildings. And so we've got an ability to, delve deep into that data, create benchmarks for our customers, and help also create very, very good estimates using that data lake to help that sort of pre-investment due diligence into understanding what this building looks like from a sort of not just from a financial perspective, but from an ESG perspective.
So within Measurable, are you targeting certain countries, regions, jurisdictions, or are you essentially following your clients?
We follow our clients. That's definitely been the way that we've kind of grown across the globe. We're in 93 countries now, and so we have building data from around those geographical locations.
Um, uh, uh, so actually having the data across 93 countries must be really interesting in terms of the benchmarking exercise you talked about there, because actually one of the main criticisms and one of the early criticisms of ESG reporting was not around the reporting, but maybe the robustness of the data that's feeding into that reporting. So do you think that criticism in the past has been fair?
I think it has, yes. And I think if we look at, regulations like SFDR, where, there was this onus on EPC ratings and using that as a benchmark tool. There was also an attempt to establish, a net zero reporting guideline called NZEB, the Net Zero Energy Buildings Directive. All those things NZEB didn't happen. Countries across Europe didn't manage to implement it as a way to to help benchmarking across buildings. And EPC ratings, as we know, are it's just a snapshot in time, and it's not a moving data point that we can reliably base our assumptions on. So actually having leveraging the data that we've got in Measurable, we actually find that our estimates can be very just much more robust as a way to benchmark that tool. So often we advise our customers to use that benchmarking data in their reporting of SFTR.
Over the last decade, there's been a proliferation of certifications, some not for profit, some for profit, and there would be a range in quality there. There's definitely a spectrum, and I think in some cases the market decides which one is going to add that layer of credibility to. But these different certifications, all ever so slightly pulling in different directions, have they been a help or a hindrance to ESG adoption?
I think initially they've been a help for sure. I think getting to a point where raising that awareness around what a sustainable building is or what a green building is, I think was a key part of the journey in getting sort of raising ESG awareness and raising awareness around, right, we need to be improving the energy efficiency of a building, and not just from an environmental perspective, but also from a social perspective. We're making sure that tenants in buildings are, that their health and well-being is being considered as well in that process. So I think they played a very important role. But I think maybe in recent times we've gone to a point where it's become a bit of a tick box exercise, and which is, I think we need to sort of step back, and we need to have a look at what are the key data points that are going to improve the performance of a building, and focus on those instead, rather than filling out these very, very long questionnaires around these green certifications that maybe have become a little bit opaque.
Yeah, and maybe this is just part of the natural process of this sector maturing, because I know certainly in the early days of Proptech Ireland, kind of going back to 2015, 2016, at that time, I think most, across construction and real estate, we saw that there had been an increase in tech adoption. So people were using technology. So therefore, for almost the first time, they had a lot of data, digital data, that they'd never had before. They didn't know how to deal with it. And I think GDPR across the EU made that more of a liability than an asset. People were afraid of it, as opposed to maybe understanding it enough to be able to extract insights. And I think now, fast forward kind of 8 years, I think we're in a place where we have so much data that actually now I think the critical conversation is, what's the data that counts? What matters? What are the metrics that we ought to be looking at? And I'm not sure that's still very well defined. In your experience, do those key metrics vary depending on the geography or the client or the objectives of the client?
Yeah, it definitely varies on the geography and the jurisdiction that you're in. I think in the US we see a lot of um, local state regulations that real estate owners have to abide by, and we're seeing this now with the proliferation of ESG acronyms and ESG voluntary frameworks, and and the regulatory compliance around it now as well. We're in danger of having a real sort of an ESG soup of acronyms that can be very daunting for real estate owners to kind of get their heads around, and trying to prioritize what needs to be, what kind of data needs to be reported. So, but thankfully, we're also starting to see a standardization of this data. We're with the launch of the ISSB, their IFRS S1 and S2 is an attempt at really trying to bring together and align a lot of that sustainability data so that we can sort of have a bit more of a consolidation here where everybody is on the same page and everybody knows what they need to be focused on, whether that be carbon emission reporting or energy consumption data.
It's interesting. Particularly kind of the sustainable and new building practices across the built environment, when that conversation started to happen, nearly a decade ago, certainly in Ireland and across the UK, we were still really in the midst of survival mode, recovering from the crash. And I think the last number of years for different jurisdictions have been really challenging in terms of the energy crisis, in terms of geopolitical the situation across Europe and outside of Europe. You're looking at Brexit, and then you're looking at the data pointing to an ever urgent environmental crisis. And it feels like when all things are urgent, nothing is urgent, so there's a real focus. And now we're in a really critical conversation around real estate. The headlines across the Irish papers over the last number of weeks are to the effect of the commercial real estate sector just needs to hold on till 2027. They just need to survive. They need to reimagine. They need to, across the UK, we're seeing a huge move towards converting office spaces into residential. We've seen a certain amount of it in Ireland, but at this point, we don't know if the figures, whether cash or carbon, are stacking up right now. We just don't have the data to say that yet. But the UK, whether they have the data or whether they don't care about not having the data, they're moving ahead with this as a strategy. In Ireland, we're not there yet, but perhaps it will happen. Given the fact that you're operating in 93 countries, what are you seeing in general? I take ESG out of the conversation. What are you seeing around commercial real estate, and how are your clients, your traditional clients, the real estate owners and operators, how are they feeling about the coming kind of 24 to 36 months?
Yeah, it's a great question. And I'm sure everybody's racking their heads trying to figure out what, whether we feel the market's bottomed out yet, or but I think, it's a bit of a mix. I mean, like you mentioned, we've got that benefit of having a view across 93 countries. But if we try and simplify that into a more manageable piece, let's look at North America, and we can look at Europe as well, and the UK. And I think those three segmentations are useful because they're all at slightly different points in the curve. So as you rightly mentioned, we had this increase in interest rates due to a number of reasons that we all know: geopolitical, supply chain, inflation, all that coming through. And so Europe, from what we've seen across our client base, is that European customers have that adjustment in valuations happen quicker. So in a way, the way we're kind of looking at it is that Europe has bottomed out quicker than the US and the UK. The UK is also quite well through that correction as well. US has been slower to correct. And I was just, reading in the last couple of weeks, there's a lot of headlines now coming out in the US around lenders to commercial real estate, particularly banks that are having to write off a lot of those loans, a lot of adjustments down in terms of their loan book in terms of commercial real estate. And so it almost feels like, oh no, things are actually not good. We haven't turned the corner yet. At least that's what it's starting to look like if you just focus on the headlines in the US. However, what we're seeing is actually there's a little bit of optimism creeping in now. We had Blackstone's president, Blackstone, one of the biggest real estate owners in the world. He said commercial real estate values are bottoming out, and he expected an uptick in realizations in the second half of this year. So the Perry network, which is the private equity real estate network, they had some good insight on this as well. They sort of feel that we're 80% through that correction in Europe and the UK. US is a little bit behind Europe, but we're starting to see opportunities come up in different sectors in commercial real estate. So industrial logistics, that has proven to be a core part of any real estate portfolio in 2023, and that will continue to be a crucial part of any real estate portfolio in 2024. There's residential, due to the changing patterns and demographics around going to the office, hybrid working. We're seeing a real shift in a lot of office transformations into residential. That's starting to come through also in the data. And then retail actually is also starting to show some interesting signs of recovery as well. So there are bright spots that we're starting to see, and our clients and their peers we're starting to see a lot of launches of new funds focused on taking advantage of these opportunities. A lot of value add funds coming into the forum as well, which is great because those value add funds means that there's a decarbonization angle there at play as well, because most of these investors are interested in picking up these brown assets and improving them from a financial perspective. And that often involves making them more energy efficient and reducing that energy consumption, which is good for the planet and good for the cash.
I want to return to maybe some of the work you're doing with on the sustainable finance side and for maybe the capital markets that sector of your clients. But just before we leave this, you've touched on really the remote working, hybrid working, the future of work. I mean, that was a highly speculated upon phenomenon since COVID, and it really is a bit of a spectrum there, from people believing, okay, we will never go back to the office 9 to 5 Monday to Friday, and I think that seems to be kind of the majority view. However, along that spectrum, we're seeing more time will be spent in the office by more people than we might have expected maybe 2 years ago as we were coming out of COVID. And in fact, interestingly, in Ireland, we have our first case that I'm aware of going before our High Court, where an employee is claiming they were essentially being penalised for refusing to go back to their office, which is on the other side of the country from where they live. And in my mind, now it's the first one that I'm aware of publicly, but I know those conversations are happening, and I believe that we don't yet know how that's going to play out. But given again your international perspective, we know that the offices have been essentially reimagining themselves even before COVID. That was starting to happen with space as a service and reimagining the future of work. It was already starting to happen. COVID accelerated it and maybe embedded some practices in a way that we mightn't have expected, or we might not have gotten to organically. But now, how are you seeing, and I know that's kind of a big question when you're operating across 93 countries, but in terms of the future of work as we know it to be today, what are the trends that you're seeing?
Yeah, so it's difficult to do a big generalization across the different geographies, but for example, if we focus on London and what we're seeing in the market here is we're not seeing companies get rid of offices completely, but what we're seeing is they're shrinking their office space. So they're either moving from some very big office spaces to smaller, to having just a few floors in an office building versus having had the whole building before. So we're definitely, I mean, HSBC is an example of that, moving from Canary Wharf into central London into smaller office space because they just don't have the need for that space as well. Canary Wharf Group also starting to transform a lot of their offices into residential buildings. So there's a big shift happening there as well in that space, and I think it's definitely going to be an adjustment. And but a lot of the commercial real estate industry has a lot of offices in their portfolio, so it's a very immediate problem, but also opportunity to transform those assets. So I think, I mean, we've got customers who are doing that transformation from office to residential, and also some doing office to multi-diversified buildings, so with retail included as well. So retail, residential, and office all in the same building.
Mm-hmm.
We're starting to see that proliferation.
Do you have any data, and apologies if this is an unfair question, but I mentioned there that actually we're only really doing a small amount of this in Ireland, taking existing office buildings, converting them into residential. The figures so far don't tend to stack up in terms of cash, but what surprised us was that I'm not sure they're stacking up in terms of carbon either. Do you have any data based on maybe some of the building transitions that you've seen?
Do we have any data? Sadly not, in terms of what those whether that means that they're getting a reduction in the carbon emissions or not. I mean, typically our clients that are that have value add funds and value add investment strategies, we typically do see a reduction in carbon emissions as they're doing their retrofits and refurbishments of their buildings. And they're very much using our data to optimize their assets. So, but in terms of data that I can share today, I don't have.
No.
Don't have
No,
any.
and it's just something I'm curious about, and I think maybe there is a benchmarking exercise that needs to happen in terms of new development versus retrofit when we're taking office into residential, because I think I think the industry will withstand it if it doesn't stack up financially, because there are, and to a certain extent, because we have supports there and we have a social remit and a social mandate. However, if the carbon doesn't stack up, then I feel like maybe we're having the wrong conversation around sustainability. And I think the line of the most sustainable building that we can deliver is the one that's already built. I'm not sure that's true if we're trying to bring it up to a standard, and the data isn't showing us that yet. So I think in the long term there is a bit of a data-driven exercise that needs to happen before we make general comments like that, and before we can stand over general comments like that. But that's again probably reflective of the stage we're in. Nuno, before we finish up today, I just want to have, maybe just to get a little bit of an understanding around, I absolutely understand the offering for your real estate owners and operators. I understand why they need Measurable and what they get out of that. For the capital markets, what problems are you solving there? And what are the problems there? What are the kind of key priorities?
Yeah, so on the capital market side, where we're really focused on is on that pre-investment due diligence process, which if we take a typical lender for commercial real estate, or even for mortgages, a mortgage loan book, they are looking at lots and lots of buildings on a daily basis, and often the data around that building is quite poor in terms of sort of the ESG side of it. So getting an understanding of you might have an EPC rating, but doesn't really that's only real gives you a snapshot. You don't really understand how that building is performing versus its peers. So what we developed is something called CDDS, which is our climate due diligence scan. And what it is effectively, it's leveraging all that data we have on the buildings, which include any green certifications the buildings might have. We look at the building type and we benchmark that building performance across our portfolio. Across our data lake to get an understanding of how that building is performing versus its building type in its peers. So there's a benchmarking aspect to that. And any local ordinance filings that there may be necessary for that, we can pull that data on that building and give the lender a very quick understanding of how that building is positioned from an ESG perspective, which is really quite a novel tool in the industry, because you have tools that focus on the climate, the physical climate risk around a building, which a lot of insurance providers have developed that particular tool. But then pulling in that other information around, green building certifications and building types and how that performance is versus its peers wasn't really available on the market. So we saw an opportunity to offer something to lenders that's a very sort of quick and easy scan for them to do ahead of going through that due diligence process on the asset.
I suppose then more broadly, do you feel, is there an understanding or from what your experience is there a good understanding across the built environment about just how sustainability and financial stability are intertwined? Is there a good understanding there?
Yeah, so I think in the lending, I would say owners and investors, they've been doing this for a little bit longer. They've got a good understanding of it, or I think a more mature understanding of the intersection between the two. But I think what we're starting to see now with a lot of the debt funds that may sit within real estate investment trusts, and as well as lenders in on the real estate portfolios for banks, that's something that's starting to emerge now. So that understanding is starting to become more widely baked in, I think. But we're still at an early stage there in terms of understanding is a sustainable building going to deliver a better yield for a bank to lend against or not. Green leases is nothing new. We've been talking about green leases for about 15 years now. But they've sort of come and gone, and now they're back again. So I think we're starting to see green leases make a bit of a return, and that is, so there's a need for data around that to understand what that means.
Very good. And I suppose final question today, because I am conscious of your time. Just, I suppose, looking a little closer to home, what are the ambitions for Measurabl and for the Measurabl team over the next kind of 1 to 2 years? What can we expect to see in terms of innovation?
Yeah, so it's actually a very pertinent question, because we are really now focused on kind of reimagining what Measurabl sort of started to do in the first place, which was really pioneering a technology and ecosystem to power sustainable real estate. And we really want to sort of come back to that sort of mission statement. And so we've actually got some really exciting product launches coming later this year, mainly in Q2, that we're going to be talking about very soon, that will really, I think, open the market and opportunity around decarbonization using data. So we're very excited about those innovations coming, and there will be further innovations coming later on than that. So yeah, for us, it's really focusing on trying to pioneer that indispensable technology and ecosystem to power sustainable real estate.
Super.
Yeah, in a profitable way.
That sounds exciting, and I suppose just by way of inspiration to others, to other innovators and pioneers in this space who might be at an earlier stage in this journey, just to remind them that the global ESG awards will be taking place, and that's run by the EU Building Innovation Network, and we're really excited that will be taking place at MIPIM next month. So it's really shining a light on technology and innovation, and again, that pioneering spirit that's really trying to improve delivery across the built environment. So we're very excited, and it's great to see Measurabl leading the space, still leading in this space a decade on. And I'm excited to hear about the new plans. So no doubt we'll be in conversation in another few months' time. That was Nuno Brito, Cunha, lead ESG advisor with Measurabl. My thanks to Katie Tallon, and producer, and to the audio team at Hear Me Roar Media. Before we go, just a special word of thanks to our sponsor, Proptech Ireland, for sponsoring the podcast and for making these conversations possible. Also, thanks you indeed for tuning in. As always, we'll catch you on the next episode of the Proptech Hot Seat. In the meantime, please be sure to check out all of the other Irish and international real estate and construction shows here on iPropertyRadio.com.